Welcome back to another episode of The Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukascopy TV. Remember, money can take care of you. It cannot take care of itself. Today, I thought we'd step out from the normal routine of looking at huge companies. We've looked at Google, we've looked at Facebook, we've looked at Volkswagen, and we'll look at a company that was huge at one point, and that's Time Inc., the global magazine company that you associate with famous magazines. Time, Life magazine way back when, Sports Illustrated, People magazine. They over 90 magazines. About 2014, end of 2013, Time Inc., which is the magazine company, split away from Time Warner. And what did it do? It was spun away at about $23, $24 a share to some of the existing shareholders of Time Warner. It's on its own now. It's about a $2 billion company. It's the biggest magazine company in the United States with, as I said, some 90 titles. But as you can see, it's been a pretty rocky road. And in the last 3 weeks, last month, not such great news coming out of Time Inc. Why? They were saddled with a lot of debt when they were spun out of Time Warner, about $1 billion, $1.3 billion, and that's been a drag on earnings. Print, dinosaur print, has not done well. Who's buying magazines at newsstands? Who's subscribing to magazines? People are. I don't want to say magazines have gone away. Digital doesn't yield what print yielded before. So it should have been a $2.5 billion company, and it was probably up here. Now the market cap, as I said, 1.718 billion. The question is, the PE is reasonable, under 9 times. The yield is good, 4.5%. And you think, well, this is an opportunity. Maybe it'll rebound from here. Here's what I don't like about Time Inc. I think it's well managed to a point, although I don't like it that they've sold a building for 700 million in London, probably the best asset they had, central London property, and used some of the money to pay down debt, good. Some of the money, however, to fund the dividend, not good. I don't think you want to be taking core assets and, there's the title of Time. Take those core assets and use them to pay a dividend. The high dividend supports the stock. They also bought back their own shares. I don't think a good idea. Yes, you can say the management has great confidence in the company, and I'm sure they do. But when this company buys back its stock and the company price falls, it's a warning bell to go off. The question is, what's the future of magazines? Magazines aren't going to go away. They'll be sold in some form. The problem is, viewers like you, subscribers to some of those magazines, don't want to pay maybe what it costs to produce the magazine. And that's the rub. So revenues are declining, net income is declining, and we've got a stock price going down. You might someday want to buy into a magazine company. I would not be buying Time at $17 a share. That's all the time we have today on The Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukascopy TV. Remember, money can take care of you. It cannot take care of itself.